both myself and my colleague Rhonda, we're delighted to have Wylie Bisset Group on board to support our members and actually ourselves with all things finance. I'm also a charity trustee myself, and I know that on many boards, knowledge of financial management and controls an area that many trustees can struggle with. And in many organisations, it gets left to the treasurer, and that's not good governance because all trustees are collectively responsible for financial monitoring and decision making. So it's really good today that Rory's going to take us through the basic financial knowledge that you will need to take up your role on a board. So I'm going to hand over to Rory now to do the presentation, and let's go.
Thank you, Tracy. Can you just give me a thumbs up? Is the volume okay?
Volume's great, thanks. Yeah.
Good, great. That's fine. That's one worry off the list. That's fine. Thank you, everyone, for coming along today. I am just going to share my screen, just so that you can see the slides that I'm going to share before we get started. And hopefully that all looks good as well.
We can see all the slides. Oh, that's it now. Great, thank you.
Excellent. Right, okay, perfect. Yes, so today, first of all, before we start, I thought I would just give a bit of an overview on myself and WBG as well, just to expand slightly on what Tracy had mentioned up front about our new partnership. As a bit of a background to myself and WBG, so I'm Rory McCall. I'm a director at WBG, and we're an accountancy practice based in Scotland. I'm a chartered accountant. I have over 10 years experience of working in accounts and audit, and I've experience in a number of different fields. However, my specialism generally tends to be charity audit and accounting, and I head up our firm's charity team. Previously, as a firm, we were known as Wylie Bisset. However, as of June this year, we rebranded as WBG. As a firm, we have 12 partners, over 150 staff, and we work across various different teams. Our office space is primarily focused in central Scotland. Our main office is in Glasgow. However, we do have other offices around the Glasgow area, and we've recently opened offices in Edinburgh and Aberdeen as well. As a firm, we work with charities throughout Scotland, as well as some in England, and are keen to bring our charity accounting expertise into our partnership with SCVO. We're aiming to help provide professional financial management advice, and through our involvement in the not-for-profit sector, we understand the importance and value of the services that SCVO provide to a wide range of charities. So we're hoping to be able to provide additional business support, expertise, and add value to charities throughout the country. So what sort of services as a firm do we provide? Well, we provide all of the services you would probably expect an accountancy firm to provide. Provide audit services to over 100 charities throughout Scotland, as well as independent examination, accounts preparation services to hundreds more. On top of that, we provide various other things, so management accounts, taxation, VAT and payroll advice as well. Through our partnership with SCVO, we're hoping to be able to bring some of that expertise to their members. As Tracy had mentioned, under the partnership, many charities will be entitled to an hour of free advice from us in various different areas of financial management. So that includes things like audits, reporting, finance policies. Can also include things like preparing for audits or independent examinations, financial management practices, queries in accounting treatments and standards of things, management accounts and budgeting and many more. If you have a question that you want to pick our brains on, then you can do. Service has only been running for a short while just now. However, we have had a lot of interesting queries on topics such as management accounting, budgeting, audit independent examination thresholds, reserves, accounting standards, and so on. So quite a broad range of areas so far. So if there's anything you're not sure on, please feel free to get in touch with us and see if we can try and help out. As part of that as well, we're also looking to share some blog and opinion pieces too in a bite-sized format. those will cover some wider sector issues as well as financial management, accounting. We are hoping to have a few out in the next few weeks, touching on areas such as changes to accounting rules for charities, which are going to be forthcoming in the next couple of years, audit thresholds, going concern, so on and so forth. Sorry, am I on mute?
Yeah, sorry about that, Rory. Could you unmute?
I'm off mute now.
Yeah, yes.
Fine. I wasn't speaking on mute like an idiot for ages, was I? No, good. That's fine. So yeah, some bits and pieces coming out in the next few weeks. So hopefully there'll be something of relevance to most there. So today I thought it'd be helpful to run through some basic financials for those primarily with a non-financial background, so that you can understand some of the key concepts that you might have to understand in your role within a charity. Cover things like what a profit and loss and balance sheet will look like, as well as some basic financial terms. What sort of things you might want to consider in your management accounts, your budgets, as well as some of the basic requirements of governance and management and how those can be achieved. So in your role as a trustee or management of a charity, lots of different types of financial information that you'll come across in your role. Some of these on screen will hopefully look familiar to you, but we will go into a wee bit more detail as to what they look like and what you'll include. So things like an income and expenditure statement, that's what it's called for a charity, but you may commonly know it as a profit and loss account, are very common, but you often have to expand on that information by breaking things down into departments. So you might see profit and loss accounts for certain functions of your charity, which cover how they run and how they're operating. You'll obviously see a balance sheet, which includes the assets and liabilities of a charity and shows its worth. You also have what's called a cash flow statement. Typically, as a charity, we tend to see two different types of cash flow statements, one being prepared for statutory purposes for a set of accounts, but they can also be prepared for forecasting and budgeting purposes as well. And on top of that, most charities also required to prepare budgets to help assess how the charity is going to perform going forward and to sign off on going concern, which is something else which I'll discuss today. Ultimately, usually in most charities, there are really two sets of accounts that you'll see. You typically tend to have management accounts, which are prepared for internal decision-making purposes and assessment. And you also have statutory accounts, which are the accounts that you're required to prepare annually and go to OSCR, and if you're a charitable company as well, or a CIC to Companies House as well. So lots of different types of financial information that you might see. So I thought I'd start off by touching on the income and expenditure account and the balance sheet. And what I'll do today is I'll look at what an income and expenditure statement and a balance sheet will look like for a standard organisation. So typically how those tend to look for a company. Charities tend to have a slightly different layout. I know we'll be running a further session in due course where I may go into a wee bit more detail as to how charity accounting rules differ and what sort of things you might see there. Today, first of all, I will just focus on what a company income and expenditure and balance sheet statement look like. So your income and expenditure statement, as it sort of says on the tin, is recording the income and expenditure for a specific period of time. Typically in your statutory accounts, that tends to be for a period of 1 year, but it can also be prepared for a month or a quarter as well for your management accounts. Your main categories in the income and expenditure account are your income, i.e. how much the charity is generating, and then you also have direct costs or cost of sales as it's known, which are the costs associated with delivering specifically that income. And then you also have administration costs or overheads as well, which are the sort of supplementary costs of like running the organisation as opposed to actually delivering a specific service. Typically, when you take your income and deduct your expenditure, you will see a profit or loss for the year. For a charity, because it is set up primarily not to generate a profit, we tend to refer to that as what's called a surplus or a deficit. In your profit and loss account, it tends to be really important if you can to report things on a departmental basis. So the charity will probably have various different functions that it might do. So it's quite important if you can to split that income and expenditure out into various different departments. Your accounting system may let you do that. And that allows you to have an analysis of those departments that are potentially profit or loss making. And just to highlight the profit and loss, which I'll show you on the next page, a charity account, as I say, will have a slightly amended layout to what's included within that. There are some very complicated rules for charities where we have to report things on what's called an activity basis and split things up into your unrestricted and restricted expenditure. So this typically is what an income and expenditure statement or a profit and loss will look like. You will see up the top we have on the left-hand side turnover, which is income which you generate in a period of time. You then have your cost of sales, which are the direct expenses associated with generating that turnover. And then once you deduct those costs of sales, you get what's called your gross profit or loss, which is essentially the core profitability of what an organisation is doing. Underneath that, we then tend to have things like admin expenses, any income which you generate from other activities which the organisation does, or any income that you might generate from interest, for example, as well. That's reported separately. And then ultimately down the bottom, you will see that an overall profit or loss is reported for a period of time. To touch on a balance sheet as well, a balance sheet, I'm sure most people will be familiar with the concept of what a balance sheet probably is or will have heard of one before. But a balance sheet is a summary of the financial position of an organisation as at a specific date. Most commonly, you tend to see a balance sheet at the end of a financial year in your statutory accounts. But as with an income and expenditure statement, you can generate one at any point of time, and it doesn't have to be as at the end of the year. Typically, you might prepare one for month or quarter ends as well. A balance sheet will include things like fixed assets, current liabilities, and long-term liabilities. We'll touch on in a minute what sort of things you might see included in there. But ultimately, what a balance sheet does is it adds up all your assets, it deducts all your liabilities, and ultimately it shows the total funds of the organisation. It's a good way of measuring sort of rough and ready solvency or net wealth of the charity, because you're taking everything that the charity holds in assets and deducting everything that goes out to third parties. And therefore, the net of those two amounts is what the charity is worth, what it has available to it in its funds. So this is what a balance sheet typically tends to look like. There's not really a huge distinction between a charity balance sheet and a company balance sheet. So what's presented here is very, very similar for both companies and charities. Up the top, you'll see fixed assets of £17,000. We also hold what's called current assets. That's £8,500. We deduct creditors, shown there, of £3,000 and £10,000. And ultimately, the bottom of the balance sheet, you'll show, in this instance, 12,500. So that is the net of your assets less your liabilities. And that is essentially the figure in this example that is what the charity is worth. It's total funds available to it. So what do each of the balance sheet headings mean? So as I mentioned in the previous page, we have fixed assets. That typically tends to include things such as property, fixtures and fittings, motor vehicles, investment. Fixed assets are what we call depreciated over their useful life. Your current assets tend to include things that are more liquid, such as stock, cash in the bank, or debtors. Debtors being amounts that are owed to the organisation for various different things, such as its core activities. And our liabilities are simply amounts that are owed by the organisation to third parties. So things like your bank overdraft, unpaid bills, PAYE, even, and VAT. So fixed assets, it's a term used to describe assets that can't easily be converted into cash. And as I say, that includes things like property, fixtures and fittings, motor vehicles, or investments. You can't go and sell something like that within a day or whatever and go and realise cash. It's things that can't easily be converted into cash. The general expectation with a fixed asset is that a charity is going to hold that asset for more than 1 year, and it will bring the charity ongoing benefits. So if you think of property, for example, your expectation isn't that if the charity holds property that you'll sell it tomorrow. You expect to hold that for a number of years and use that property so that you can generate income from the charity through your activities. So sort of fixed into the charity's asset base. The fixed assets are held at the top of the balance sheet, and as I say, they are depreciated over their useful life, which is a really common accounting term. Depreciation is essentially the allocation of a cost of a fixed asset over its period of use. So when we buy a fixed asset, in the year of purchase, what we don't do is we don't recognise that as an expense through your profit and loss. What accounting standards require us to do is basically put that fixed asset in a balance sheet, and then the depreciation sort of recognises that cost over its useful life. So it's not a cash expense to the business, but it's essentially showing what the expense of using an asset is each year. So for example, if you think about if a charity purchases a van, let's say for £20,000, and you expect to hold that van for a period of say 4 years, what we do is we recognise £5,000 of depreciation in each of the 4 years that van is held in the accounts. So it's £5,000 in years 1, 2, 3, and 4, and that equates to the total £20,000 cost. So that would be shown as an expense in your profit and loss account. And what happens at the same time is that motor vehicle, which you originally held at £20,000, will then reduce in value as time goes on. So at the end of year 1, it's then worth £15,000, year 2 down to £10,000, until eventually it has no value left and it's no longer held in fixed assets. Typically, it's common for most assets, in my experience, for charities to assess them as technically worthless at the end of their useful life. However, a charity can decide that an asset would still be worth something at the end of its useful term. So if you expect, for example, that at the end of those 40 years, the van's going to be worth £2,000, you would depreciate by £4,500 each year. So at the end of that period of 4 years, you're still holding £2,000 worth of assets. So depreciation, there are no fixed rates. You, as a trustee, are probably expected to sort of make a reasonable assessment as to how long a fixed asset should last and come up with what's called a depreciation policy. And that's how long that you want to depreciate each of your assets for. So there's nothing in the accounting standards that say you have to depreciate over a certain length of time. You just do it over what you feel is an appropriate length. I'd also mentioned when I was run through the balance sheet current assets, and as I say, those are assets that we typically tend to call liquid, and that includes things such as stock or cash or debtors as well. Liquid assets are assets that are actually cash or will convert into cash readily. So for example, stock, you expect to be able to sell that almost straight away and generate cash from doing that. We also include things like debtors as well, and debtors typically include amounts due to the charity for things like unpaid invoices for its services, but they can also include things like claims for grants due but not yet paid at the year end as well. Your general principle with a current asset is that the asset will be cashed in less than 1 year. So there's a distinction there from a fixed asset being more than 1 year. A current asset is something we expect to realise within the next 12 months. And we also have current liabilities, which are essentially the opposite of current assets. Current liabilities are amounts which are owed by the organisation that are payable within 1 year. So that's your bank overdraft, if you have one, unpaid bills, PAYE, VAT, essentially any amounts which you're due to pay out to third parties. Any unpaid expenditure invoices are recognised as what's called a trade creditor. So that's expenses you've been invoiced for in a normal course of business which haven't been paid yet. You may have creditors for costs that you've incurred. So as I mentioned with debtors, there are sometimes grants which we know we've been paid that we haven't invoiced for yet. Creditors, we can have the opposite, costs that you know you've incurred which haven't been paid. So that can include things like electricity, rent, professional fees as well, where the invoices sometimes come in after the year end and we accrue them back into the financial year. So they're known as accruals. So current liabilities can come in various different shapes and sizes. Just to touch on something that's called the trial balance. This is a term which you may hear referred to in various different guises. Just to touch on what a trial balance is, it's a summary of all the balances from your income and expenditure account and your balance sheet, essentially in a big long list. Usually if you've got an accounting system you use, it can generate a trial balance at any point in time, which shows what all these balances are. Trial balance is typically the key starting point used to prepare your accounts. Your accountant or auditor will usually request a trial balance after the year end has passed, and that's to allow them to pull a set of statutory accounts together. A trial balance can be useful on an ongoing basis if you just want to see at any point in time what any balance sheet or income and expenditure amount is sitting at any point in time. However, it does typically tend to be much more useful once it's translated into a set of accounts and it can be interpreted a lot more easily. So now we've touched on some of the key concepts, I just wanted to discuss briefly management accounts and budgeting and things like that. Within any organisation, your financial information is prepared for a lot of different purposes. So you can prepare it for statutory requirements to produce your year-end accounts, but it might also need to be done for management information for the purposes of decision making, or for things like budgeting and forecasting, looking forward as well. And also on top of that, you might have funding applications that you have to prepare where you have to include information looking forward to or certain financials about how you've been getting on. So it's important for any charity that financial recording is structured in a way that allows the preparation of information for all of these purposes. It's important that a charity analyses accounting packages or formats that are appropriate for the size of them and meets all the different reporting requirements that they are going to have to meet. Statutory accounts have a set format. The profit and loss and balance sheet I showed you earlier are typical extracts of what you might see in a set of statutory accounts. But your management accounts, your internal reporting can be prepared in any way which best suits the needs of what the charity does. There are no statutory requirements in terms of what you have to put in your management accounts. Just prepare them how is best for you and what gives the trustees what they need. Statutory accounts are typically produced once annually. Management accounts can be prepared as regularly as you need to do them, so usually monthly or quarterly for most charities. So as I say, they're information produced for internal use. There's no set format, no set content, there's no set frequency either. You just need to ensure that it's suitable for your charity. I'd mentioned up front that you might want to consider departmental reporting as well. So whereas a set of statutory accounts typically tends to just tell you what the overall charity has done as a whole, your management accounts can often be much more useful if you split it into departments or activities, which explain what certain functions of the business have been doing, so that you can sit and analyse them individually, and where you may need to cut back on costs or try and generate additional income if certain activities are potentially loss-making. Whilst management accounts do not have to have a set format, I would always advise, if possible, to try and include a balance sheet, try and include a cash flow statement if you can in your management accounts. I do typically tend to see from a lot of the charities that I work with that many of them do just include income and expenditure. Whilst that can be helpful, it doesn't really give a good picture of where the charity might be sitting financially at any point in time, what its overall wealth is, what its cash position is. Cash position in particular is always going to be really critical for assessing the charity's sort of financial stability. So I would always recommend, if possible, that you think about including cash flow information too. And it's always really important, particularly from a trustee's point of view, that you ask questions when you're presented with management accounts, that you don't just accept the figures that are given to you and think, oh, well, someone knows what they're doing with these. It's important that you scrutinise them and ask questions too. And I'll touch slightly later on in terms of the sort of responsibilities of both board and management there. When preparing management accounts as well, it's also really important to consider what your key performance indicators or KPIs might be as a charity. I'd like to think that all charities will have financial KPIs to some degree, whether that's what income targets you're looking to generate, what surplus or deficit you're aiming for, what your target level of reserves is. A lot of charities are required to have what's called a reserves policy. So a reserves policy is in itself a type of financial KPI. May also be things like having a clean audit report or employee matters such as turnover or costs as well. So there's lots of different areas that you can have these KPIs. And again, I think it's something that's really important that charities determine what they are and consider reporting on them as part of their management accounts too. I think personally myself, I always feel that a reserves policy is a really important KPI for a lot of charities to consider. And to me, I think a lot of charities sometimes only really consider that at the end of the year. They look at that retrospectively. It's really something that should be getting looked at on a regular basis, so monthly or quarterly. Are we above or below what our reserves policy is? And is there action that we should be taking to try and take those in line with each other? When you're preparing accounts, your management accounts, what sort of things might be key risk indicators? What sort of red flags might you want to be looking out for? I mean, it's going to vary charity to charity, really, but to me, ones that would stand out would be lack of regular up-to-date information. If trustees aren't being presented with management accounts, if they're being presented with management accounts several months after the information's taken place, where it may at that point then be out of date. That's something that would be a concern. Unexpected deficits, I suppose that probably goes without saying, but if your budget projected for a break-even position and actually you've ended up with a significant deficit for a period, why has that happened? Is a potential income stream dried up that you weren't aware of, or have you forgotten to bill for certain amounts, i.e. is there income missing from our accounts? That's something that would stand out. The solvency of the balance sheet as well. If you add up all your assets and deduct your liabilities, if your liabilities outweigh your assets, you're technically looking at an insolvent position there. So if your balance sheet is insolvent, why has that happened? And do we need to take immediate action to try and address that? As I mentioned, performance against your KPIs. What are the targets that we set as an organisation? Are we achieving those, or are we well off them? And then other things like general trends. So over a period of time, if the charity's cash balance is generally tending to fall down and down, or are unrestricted reserves available to us are reducing, that can often be a bit of a red flag in terms of ongoing financial stability. Even things like increasing debtors or creditors, if the amount that we are owing to people each month keeps going up, does that indicate that perhaps we're having to manage cash very carefully to try and manage our wealth? Or increasing debtors as well. If debtors, the amounts that people owe to you are going up, is there an issue in terms of our credit control? Do we potentially have people that we work with are struggling, and we need to assess whether we do business with them going forward? So big variances. Variances are often things that you have to look out for, and you have to understand why that's happening and what action you might want to take if that is the case. So budgets, I'm sure everyone today will have heard of a budget at some point in their life, even if they're not necessarily familiar with them financially. But yeah, it's a list of planned income and expenditure. Typically, what we tend to do with budgets is we base them on historical data, so we're not starting fresh every single year. You start based on what you know the charity has done in the past, and then you try and build in expected changes going forward. So if you know that, for example, an income stream won't repeat next year, you would take that off the list. If you know staff costs are going to increase by, say, 5%, you'd want to build that in. It's too difficult to start afresh every year. Really, you need to be looking at what has happened in the past and then try and build assumptions in for what's going to happen going forward. Organisations really probably should have detailed short-term budgets, so for a period of, say, 1 year or so, and then ideally, not required, but ideally you would probably want to have a plan in terms of what you're doing going forward, so longer-term budgets for a period of 3 to 5 years, which are potentially in a sort of, I know it's difficult to prepare longer-term figures, so usually a slightly reduced basis from what you would see in your 1 year budgets. I'll touch on a minute why it's particularly important to have a 1 year position, but when you are progressing through a year, it's important to regularly go back and look at what you said in your original budget. I don't just let it lie. Try and look at what's happened throughout the year, make forecasts, look at budget versus actual, and sort of regularly reassess as the year's going on. And also, it's good to prepare departmental budgets for each of the activities that the charity does. Yeah, I do see a lot of sort of one-page things where we've really just got a headline income and expenditure figure. The more detail that you can build into the budget will mean it's easier and easier as the year progresses to understand why things might have varied from the original position. It's also important to prepare cash flows as well. Cash flow being a projection of how cash is expected to move in and out of the business over a set period. It's very important, cash flows as for financial planning purposes, because if a business runs out of cash, it can't operate. Typically, you'll see two types of cash flow statement. So you will have a statutory cash flow, which some charities are required to include in their financial statements, and that's a backwards looking position. How did cash move in and out of the business during the year? And we also have a management of cash flow, which is produced for management purposes and is forward looking and is how we expect cash to move in and out over the next 12 months. They're very important for internal decision making, should be regularly monitored and revised, and ultimately is going to be a key aspect in terms of feeding into going concern. Cash flows, what are the red flags you might see in there? Typically, cash sort of running out is always a key one, so projected deficits in cash is always going to be a bit of a red flag. If you have a big capital project on the horizon, have you factored in the amounts and timings of any sort of capital expenditure you're going to be incurring? Are you going to have the money to pay those bills when they come in? If we receive funding in arrears, are we going to have to incur the costs up front? before we get the income in, which might have a big impact on cash. Having to use restricted cash to pay unrestricted bills. Obviously, restricted cash typically tends to have a restriction placed on it, which means that we can't spend it on unrestricted amounts. So if we have to borrow from our restricted funds to pay our unrestricted bills, that could be a red flag. And lastly, a lack of cash flow forecast as well. If they're just not prepared or for any reason they're not provided, then it's a bit of a red flag too, because how are you actually monitoring your cash position on an ongoing basis? So these budgets, these cash flows feed into a term which is known as going concern, which is very important and is an accounting term for a company that's financially stable enough to meet its obligations and continue in business for the foreseeable future. Any trustees of a charity have a duty to assure themselves that a charity is a going concern for a period of at least 12 months and then sign off their accounts on that basis. So it's something that the trustees have to satisfy themselves on and sign off on annually. That 12-month period will always start on the date that your accounts are signed off, not the year end. So if you're a March year end, but you don't sign your accounts until the end of September, you have to be looking forward to the following September, as opposed to just 12 months from your year end. Any material uncertainties regarding going concern should always be highlighted to the users of the accounts in the notes and probably the trustees report as well. Budgets, forecasts and cash flows should be used as the key tool in determining this basis, ensuring that you're receiving the cash flows, the budgets, you're reviewing them, and that you're approving them before the accounts are, because they're going to be one of the key things that you use to determine a going concern basis. You need to ask questions about those as well. As I say, it's one of the duties of the trustees. So I think you need to, as Tracy said up front, don't just rely on a treasurer to make all the decisions for you. If there's anything that stands out to you, make sure that you're asking questions. When it comes to going concern as well, consider other factors. Are there any significant legal cases that might make the charity wind up? Is there expected to be a reduction in demand for our services? How might things like inflationary impacts factor in as well? Have those been factored into your forecast too? An auditor or independent examiner will likely make their own assessment of going concern as well, but ultimately it's important that the information you're receiving is produced in a format that allows both a trustee and an auditor to make a reasonable assessment over going concern. So lastly, today I just wanted to touch on some various different things in terms of board responsibilities, management responsibilities, how they can sort of work in harmony together to try and make the financial reporting process as straightforward as they can. I mean, any trustee board have a lot of responsibilities, a lot of them determined by what's in the charity's governing document, what's in charity legislation, so on and so forth. I mean, ultimately, some of the key ones will be ensuring that the charity is actually run for public benefit. It's not just operating commercially, that it's doing what it was set out to do, complying with its governing document, as I said, and ensuring that what's in its memorandum and articles or constitution is being applied on a day-to-day basis. Then you've got other ones like acting with due care and skill, ensuring accountability for what the charity does, and managing resources responsibly from a financial point of view too. So there's lots of different things that the trustees are responsible for overseeing as a charity. And typically, even though management don't have as many statutory responsibilities in terms of the governance of the charity, there is often an expectation of the board that the management of the charity will certainly help out in terms of the trustees achieving those responsibilities that they have. So there's various different things that management can do in respect of that. So what sort of things are those? Going back to what I've said, preparing management accounts, ensuring that they are in a meaningful format for the trustees, so something that's easy for them to understand, tailored for the the expertise which is on the board, and it takes into account any feedback in terms of what trustees might like to see in their management accounts. Preparing narrative and explaining variances as well is really helpful for the trustees too. So explaining why things might have varied month on month, explaining why we might have varied from our original budgeted position, and ensuring that they're provided on a timely basis as well. So not providing much information in September. You'd probably want something a lot more sooner than that, so that it can help with the decision-making process. Boards have their own reporting requirements, so providing statutory accounts to OSCR, to Companies House, that's certainly something which I do see delegated to management or your auditor or independent examiner as well, so that's something they can help out with. From a statutory point of view, it's always helpful to get management involved in the preparation of the statutory accounts. So even though it's called a trustees report, I think it's helpful for management to be involved in the production of a trustees report, because they can feed in from a management point of view what the charity's been doing day to day, how it's run, what its key activities have been. I think that helps ensure a fairly well-rounded document as well, if you have various different people feeding in. Circulating accounts in plenty of time, reconciling statutory accounts to management accounts. Sometimes you might see some variances between your statutory accounts and management accounts due to year-end adjustments being made. I think it's important for management to reconcile those positions if there is a variance, so that trustees can understand why that's happened and that they're happy to sign off for them. And probably asking our auditor to be present as well, so if there's a board meeting held to discuss the accounts at the end of the year, asking our auditor to come along to explain things in a bit more detail can often help. There's also various other things I might want to consider too. So doing a board skills audit to make sure that there's appropriate expertise on the board, such as financial, legal, HR expertise if it's required. Things like setting up a finance subcommittee as well. And ultimately, I think one of the key things is setting internal controls. Internal controls, very wide-ranging, but ultimately it's the trustee's duty to safeguard the charity's assets and keep a proper accounting records. So ensuring that there are appropriate internal controls in place is very important to ensuring that. So having robust documented procedures, such as a finance procedures manual, if it's appropriate, ensuring that there are appropriate authorization controls in place so that cash can't get out of the business without authorization, ensuring there's segregation of duties so that not one person is doing everything, that also prevents cash getting out of the business. It's important whatever internal controls are implemented, and there's so many, that they are regularly revised, they're overseen by trustees, and they're updated if there are, for example, changes in staff numbers or high staff turnover, and that they are taken into account too. So what sort of things, when internal controls are implemented, suggest that they might not be working? Potential red flags there. Probably any sort of qualified independent examination or audit report is always a big red flag that the internal controls you put in place maybe need a wee bit of revision. Qualified audit report tends to only really come up where something has gone significantly badly. So if you do have a qualification there, it suggests that there's probably a certain aspect of how the charity is being run that really needs to be looked at and control strengthened in respect of that area. If your auditor or independent examiner provides a supplementary recommendation letter when the process is done, they might have some recommendations that they build in terms of how controls can be improved. Again, if there's a lot of recommendations that they're raising, often suggests that there's areas that could be improved, whereas a clean report is often an indication that what the trustees have implemented is working well. lack of segregation of duties. If one person is doing everything, so initiating orders, raising invoices, paying bills, again, that's a big red flag, because often there's nobody overseeing what they're doing, and it increases the risk of misappropriation of their assets. Or rapid growth as well. If a charity grows very, very quickly, it increases the likelihood that the internal controls that you put in place may need some revision as well. They might not be currently fit for purpose. So that's something to consider too. It's important, no matter what you do, that if controls aren't being adhered to or aren't working, that you look to take action as soon as you possibly can to address any weaknesses which are picked up. Just to summarise some of the key things, I think, today, ensure your accounting records are adequate, ensure that they're presented in a format which are useful for the trustees, particularly your management information, in a format that's meaningful, it's accurate, it's current, and most importantly, allows management and trustees to actually make decisions that they need to do and are able to see the figures that they want to see. Ensure your budgetary process is robust. Ensure where possible that you have short-term budgets, potentially long-term budgets if you think they're beneficial, that you have cash flows if you can, and that you're looking back on those as the year progresses to see why things might have varied. And lastly, ensure your internal controls are fit for purpose. Say the board of trustees have a lot of responsibilities, and ensuring that there's a strong internal control environment will certainly help in terms of ensuring that those are met. Thank you. I think that's everything I was going to cover today. I might hand back to you initially, Tracy. I don't know if anyone has any questions that they wanted to ask. Or...
Yeah, that was great. Thank you, Rory. I certainly learned a lot. And I think for many people, financial management is quite overwhelming. So you presented it in such a way that even I understood it. So thank you for that. I'm going to stop the recording now and go to questions.